You're listening to the Valley Current.
So today is April 4th, 2026. And I mean, if you've been following the news at all, you know the tech finance world is currently completely upside down.
Oh, completely. It's unprecedented.
Right. So to start us off, I want you to imagine baking a pizza. But not just any pizza. Imagine a pizza that is worth the combined gross domestic product of Portugal and New Zealand.
That is a very expensive beef.
Right. Just a sprawling, incomprehensibly valuable asset sitting right there in front of you. And now imagine that the chef who baked it, the person who spent the last decade painstakingly perfecting the recipe, is legally forbidden from eating a single slice.
Which just defies all logic.
Exactly. But today, we are opening up the leaked financial DNA of OpenAI. And I promise you, whatever you think is happening behind the closed doors of the tech world's biggest company, well, the reality is just far more bizarre.
It really is. Because what we are looking at today, it isn't just a spreadsheet. It's a map of how global capitalism is being fundamentally rewired in real time.
Yeah.
And if you are listening to this right now, whether you are commuting to work or sitting at your desk, or maybe you're even using ChatGPT right now to help draft an email, you are participating in an ecosystem that is currently buckling under the weight of its own financial contradictions.
Yeah, that's such a good point. And our guide through this entire maze is a single, incredibly detailed source.
Yes.
We are breaking down a special report. It's from the April 3, 2026 edition of the Computer Law Group, or CLG LLP newsletter. And it was authored by their managing partner, Jack Russo.
Right. And Russo's mission in this newsletter is basically exactly our mission for this deep dive today.
Exactly. We are going to reconstruct, piece by piece, the strictly confidential Series G capitalization table that just leaked on April 2.
Which is huge. To give you a sense of scale before we dive into the actual mechanics, we are talking about a post-money valuation of $852 billion.
I mean, just let that number sit for a second. $852 billion.
Yeah. And this follows a $122 billion Series G fundraise, which officially closed on March 31st.
Wow.
And that raise, by the way, is the single largest private capital raise in human history.
Okay, let's unpack this because, wait, let me stop you right there. I want to address the elephant in the room immediately.
Sure.
You said leaked, right? And the source says strictly confidential. If this document is so highly guarded, how do we even know these numbers are real? I mean, how do we know Jack Russo isn't just, analyzing some fabricated spreadsheet someone posted on a random message board?
That's a vital distinction to make right up front. The source clarifies that this isn't a leak in the sense of like a malicious server hack. Russo refers to it as a sophisticated reconstruction.
So it's pieced together.
Yes.
But from what exactly?
From a massive constellation of hard data points. You start with publicly available SEC filings.
Right.
Because any company of this scale inevitably generates those, even when they're private. Then you layer in disclosures from secondary markets platforms like Forge Global, where early employees sometimes try to sell their private shares. Then you add in the paper trail of official investor disclosures, and finally you cross-reference all of that with numbers the company itself has officially confirmed on its own corporate blog over the last few years.
I see. So it's kind of like having a 1,000-piece jigsaw puzzle where the company has only officially released, say, 800 pieces.
Right, exactly.
But because those 800 pieces are completely locked in place, financial analysts can infer the exact shape and color of the missing 200 pieces with, well, near absolute certainty.
Precisely. And the broad figures in this reconstruction, they align so perfectly with a confirmed public record that institutional financial analysts are taking it completely seriously.
Okay.
The foundation of the map here is rock solid.
Okay, so the math is real. Let's look at the sheer scale of that math. The report has this explain number. Like I'm 5 concept, treating the company like an $852 billion pizza sliced into 100 parts.
The pizza analogy is perfect for this.
Yeah, so out of those 100 slices, Microsoft holds about 27 slices. The nonprofit foundation holds about 26. SoftBank has 12. The employees hold about 19 slices, and the remaining 16 go to various other investors.
And when you translate that pizza into the raw technical depth, the numbers are just staggering. Following that historic March 31 raise, the report notes the company now has approximately 23.4 billion authorized shares.
I can't even visualize that. I mean, if you own a small startup, maybe you issue a few million shares, right?
Sure.
$23.4 billion is astronomical.
And those shares, they are not created equal. To really understand who controls this $852 billion entity, we have to look at how those 23.4 billion shares are divided. They're split into 3 distinct classes.
Okay, break that down for me.
So you have Class N common stock, you have Class B common stock, and then you have your standard preferred stock.
Walk me through the difference, because I assume this isn't just some arbitrary naming convention. Like, what does Class N actually do?
Class N is the master key. It is held exclusively by the nonprofit foundation, and it carries full 100% governance control.
Oh, wow.
Yeah. If you hold Class N, you dictate the board of directors, you dictate the corporate strategy, you can literally hire and fire the executives at will.
Wow, okay. And what about Class B?
Then you have Class B common stock. This one is interesting because it carries absolutely no voting rights.
Zero.
It is essentially just corporate currency. It's primarily minted to be used for acquiring other companies or, compensating certain tiers of employees without giving up a single ounce of control.
Which leaves the preferred stock.
Yes. The standard preferred stock is what the outside investors hold. So your venture capital firms, your massive tech conglomerates, they get a preferential place in line if the company is ever liquidated, sure. But they do not get the governance control that you would typically expect for the billions of dollars they are risking.
And when you divide an $852 billion valuation by 23.4 billion shares, the value of even the tiniest sliver of this company becomes just mind-bending.
The report breaks it all the way down to the basis point.
Right.
In finance, a basis point is 1/100th of 1%, so 0.01%. On this specific cap table, a single basis point is worth $85.2 million.
0.01% is $85 million. I mean, if you drop a rounding error into the spreadsheet, you are misplacing the GDP of a small island nation.
Exactly. It completely dwarfs all historical precedent. I mean, if you look back at the corporate histories of Facebook or Google or Amazon, they certainly reached these astronomical valuations eventually. But they did it after they went public. They did it on the open stock market, where they were subjected to daily public scrutiny, achieving an $852 billion valuation while remaining a privately held company that is entirely uncharted territory.
It really is. And yet, in the middle of this uncharted $852 billion territory, we have what is easily the most baffling row on the entire spreadsheet.
Oh, yeah.
In the original leaked document, the source notes, it's literally highlighted in yellow, the CEO, Sam Altman. Let's look at his compensation, because the cap table lists his annual salary at exactly $76,001.
Which, crucially, is the legal minimum salary required in that specific jurisdiction to qualify an employee for standard corporate health benefits.
He is literally making less than a junior copywriter at a mid-tier advertising agency. And his equity in the company, according to this detailed reconstruction, it is 0%. He owns 0 shares.
What's fascinating here is, well, you really have to look at the why.
Because the instinctive reaction is, he's independently wealthy from his days running Y Combinator and his other investments, so he just doesn't need a salary. But to hold 0% equity in a company you built into an $852 billion behemoth, that goes against the most fundamental laws of Silicon Valley physics. How is that structurally possible?
To understand the 0%, you have to understand the ghosts of this company's past. You really have to look at its origins in 2015. It didn't launch as a standard Delaware C Corp.
Wait, let me pause you there. A Delaware C Corp, that's the default setting for almost every tech startup, right? Because the corporate laws in Delaware are incredibly friendly and predictable for investors.
Exactly. Venture capitalists generally demand a Delaware C Corp structure right out of the gate because they know exactly how the preference stacks, the voting rights, and legal liabilities work. But OpenAI didn't do that. They launched as a 501c3 tax-exempt charity.
Like a local food bank. Or, the Red Cross.
Functionally and legally, yes. And under U.S. law, a 501c3 charity cannot distribute equity, dividends, or profits to its founders or its employees.
Right.
Its assets must be permanently dedicated to its charitable public benefit mission. So from day one, there was literally no stock for the CEO to take.
Okay, that explains 2015. But the source outlines that things changed dramatically in 2019. They obviously realized that relying on charitable donations to build massive supercomputers wasn't going to work.
Right.
So they created a capped profit entity, and at that point, they were minting equity. So why didn't he take a massive chunk then?
So the specific mechanism they used in 2019 was called profit participation units. Altman was actually offered these units, but the records reports show he explicitly declined them.
Why? I mean, if you're building the most important technology of the century, why turn down the upside?
According to the legal logic detailed in the report, he did it to maintain what is called a majority disinterested board.
A majority disinterested board.
Yes, right. In nonprofit governance, you're required to have a board of directors that makes decisions entirely free of personal financial conflict. Their only loyalty must be to the charity's mission. By refusing to take any financial stake in the new capped profit arm, Altman could sit on the board and legally claim he was a disinterested director.
Like, I'm just here for the mission of humanity. Ignore the billions swirling around the room.
Exactly.
But surely that logic expired recently, because we know that in October 2025, they went through a massive restructuring. They officially converted into a public benefit corporation, a PBC, that is a for-profit entity. Yet, looking at this current cap table from April 2026, he still has zero.
Yep. Even during that October 2025 PBC recapitalization, he received nothing. To really put into context how historically anomalous this is, consider the founders who defined the last era of tech.
Okay.
Mark Zuckerberg has been heavily diluted over 2 decades, yet he still retains roughly 13% of Meta. Jeff Bezos holds about 9% of Amazon. Jensen Huang holds about 3.5% of NVIDIA.
And 3.5% of NVIDIA right now is worth something like $150 billion. I mean, even Steve Jobs, who famously had a very complex relationship with Apple equity, he held over 5.5 million shares when he passed away, which was worth over $2 billion at the time.
Right.
In all of those historical cases, the founder's wealth was symbiotically tied to the company's valuation from the moment of inception. Altman is basically stranded on an island with nothing.
Except the island is currently negotiating a bridge.
Ooh.
The report details a pending equity grant that has been widely discussed in legal circles recently. The figure floating around is 7%.
Okay, let's do that math. 7% of an $852 billion post-money valuation. That is a single stock grant worth $59.64 billion.
If executed, it would be the largest single compensation event in the history of corporate finance.
Wow.
It would instantly mint Altman as a top 15 global billionaire, basically overnight.
Here's where it gets really interesting, though. I'm stuck on the mechanics of this. How does a company actually greenlight a $60 billion check to its CEO? Like, who sits in a boardroom and authorizes that?
This is where the structural oddity of OpenAI becomes a massive bottleneck. Because of the way they are organized, the final approval for that massive grant cannot just come from the investors.
Right.
It must be approved by the board of the nonprofit foundation, which, as we established earlier with the Class N shares, still holds total governance control over the for-profit PBC.
And who is sitting on that foundation board?
Sam Altman.
Wait. Sam Altman is on the board that has to approve Sam Altman's unprecedented $60 billion payday.
It is the ultimate textbook definition of a conflict of interest. Now, the board chair, Brett Taylor, has been forced to address this publicly.
I would hope so.
He acknowledged that the board has discussed granting equity to Altman, but he phrased it as a consideration of whether it would be, quote, beneficial to the company and our mission.
Beneficial to the mission to turn the CEO into a mega billionaire. That is a truly fascinating interpretation of public benefit.
Taylor was also very careful to caveat that no specific numbers have been officially tabled and no formal decisions have been made. And the real reason no decisions have been made is that they are entirely paralyzed. They literally cannot issue this grant right now.
Because of the lawsuit.
Because of the lawsuit. That $60 billion payout is completely frozen by the ticking clock of an existential legal threat from Elon Musk, which, of course, we will dissect in detail shortly.
Oh, we definitely will.
But before we look at the lawsuits trying to tear this valuation down, we really have to look at the investors driving this valuation up.
Right. If the CEO isn't capturing this $852 billion, who is? This brings us to the biggest gambles on the board. The investors, specifically the two massive pillars holding up this entire financial structure, Microsoft and SoftBank.
Let's examine Microsoft's position first, because it's fascinating. According to the cap table, Microsoft holds 26.79% of the company.
Over a quarter of the company. At this valuation, that slice is worth approximately $228 billion. And the report notes they achieved that by investing roughly $13 billion over several tranches starting back in 2019. That translates to a 17.6x return on their deployed capital.
From a pure return on investment standpoint, it is a total masterclass.
Right.
But what is mechanically fascinating is what Microsoft does not have.
Right.
Despite holding the single largest economic stake, more than a quarter of the entire enterprise. Microsoft holds exactly 0 board seats.
Which makes absolutely no sense in traditional venture capital. If a VC firm buys, say, 20% of your Series A startup for a few $1,000,000, they demand a board seat. They want to be in the room where the decisions are made. Microsoft puts in $13 billion, gets almost 27%, and they don't even get a chair. Why would they ever agree to that?
Because of the antitrust optics. Microsoft already has a massive, complex commercial relationship with OpenAI. That includes a staggering $250 billion commitment to provide Azure cloud computing infrastructure.
Right, the compute.
If they also held formal governance power, if they were officially sitting on the board directing the company's maneuvers, regulators in the US and Europe would immediately classify it as a shadow acquisition.
Oh, I see.
By keeping their name completely off the board roster, Microsoft can argue they are just a passive investor and a vendor, not a controlling entity.
Right. They can just say, hey, we just sell them server space. We promise we aren't running the show. It's a brilliantly constructed legal firewall. But if Microsoft is playing this careful, calculated game of regulatory chess, SoftBank is doing the exact opposite.
Oh, absolutely. SoftBank and its founder, Masayoshi Son, are playing a game of unprecedented high-stakes financial leverage. SoftBank holds an 11.66% stake.
And to get that 11.66%, Masayoshi Son placed a jaw-dropping $64.6 billion bet.
I really have to let that number breathe. $64.6 billion deployed into a single, privately held company. That is larger than the GDP of many sovereign nations.
You don't just find $64 billion in the couch cushions, you know. The CLG report breaks down the mechanics of how SoftBank actually funded this, and it happened in 2 distinct tranches.
The first tranche was $41 billion. SoftBank deployed this capital when OpenAI was valued at around $300 billion.
Okay, so on that first tranche alone, because the valuation has now nearly tripled to $852 billion, SoftBank is sitting on a paper gain of roughly $52.7 billion. They look like absolute geniuses.
On paper, yes. But the mechanism for the second tranche, the capital they needed to reach that total $64.6 billion figure, that is where the systemic risk enters the picture. SoftBank didn't use cash on hand for the remainder.
No.
They arranged a $40 billion unsecured bridge loan.
I want to stop right here because this is the craziest detail in the entire source. A $40 billion unsecured bridge loan. Explain the mechanics of this to me. How does a company borrow $40 billion, and what does unsecured actually mean at this scale?
So when a loan is unsecured, it means there's no specific hard asset pledged as collateral. If you or I buy a house, the mortgage is secured by the house. If you default, the bank takes the property. In this case, SoftBank didn't pledge specific physical assets or even specific stock portfolios to back this $40 billion.
So what is backing it? Just a handshake?
It's backed by SoftBank's general corporate creditworthiness. It is backed by the full faith and credit of the SoftBank corporate entity itself. And to facilitate a loan of this magnitude, you can't just go to one bank. You have to create a syndicate.
A group of banks sharing the risk.
Exactly. The report names the syndicate: JP Morgan, Goldman Sachs, Mizuho, SMBC, and MUFG. 5 of the largest financial institutions on the planet banded together to issue the largest dollar-denominated loan in SoftBank's entire corporate history.
I am genuinely struggling to understand the risk management at JP Morgan or Goldman Sachs looking at this deal. Because if you look at Masayoshi Son's recent track record, I mean, the newsletter explicitly brings up the shadow of WeWork.
You cannot talk about SoftBank without talking about WeWork. SoftBank incinerated roughly $16 billion betting on WeWork's co-working model before it totally collapsed.
Right. So the guy who lost $16 billion on a fancy real estate startup walks into Goldman Sachs and says, hey, I need to borrow $40 billion to bet on an AI company. And they just say yes. I mean, S&P Global doesn't seem to think it's a great idea.
No, they don't.
The report notes S&P assigned a negative credit outlook to SoftBank specifically because of this concentration of risk. I mean, this one bet on OpenAI now constitutes 30% of SoftBank's entire investment asset portfolio.
It is a staggering concentration of risk. And it's not just financial risk either. Son and Altman are becoming deeply operationally entangled. The newsletter reports on a joint venture called the Stargate Project.
And just so we are totally clear with you, the listener, we are reporting the facts here exactly as they appear in Jack Russo's CLG newsletter. The source notes that this project was announced at the White House, involving President Trump and Oracle's Larry Ellison. We are simply relaying the source material's outline of the players involved in this massive infrastructure deal without endorsing any political viewpoint.
Right. And the Stargate Project is described as a $500 billion artificial intelligence infrastructure initiative. The plan is to build massive data centers across Texas, New Mexico, Ohio, Wisconsin, and 5 key international markets.
So SoftBank isn't just buying shares on a cap table. They are committing to building the physical, concrete, and steel infrastructure that OpenAI needs to actually run its models. They're completely intertwined.
Yes.
But I keep coming back to that bridge loan. Why use a bridge loan? Like a bridge to what?
If we connect this to the bigger picture, that is the most critical question of this entire deep dive. A bridge loan is, by definition, short-term financing designed to bridge a gap until a larger, more permanent liquidity event occurs. And bridge loans have very strict maturity dates.
When does this one mature?
March 2027.
March 2027, so less than a year away.
That date is the ultimate forcing function of this entire corporate saga. Masayoshi Son has to pay back $40 billion to that syndicate of global banks by March 2027. Where does he get $40 billion in cash?
Yeah.
He has to sell shares of OpenAI.
Right.
But he can't easily sell $40 billion worth of private shares. The company absolutely must go public.
So the timeline for the OpenAI initial public offering isn't necessarily being dictated by, when their AI models reach a certain capability or when the consumer market is perfectly primed. The IPO is being forced by a ticking debt bomb sitting on a balance sheet in Tokyo.
Precisely. SoftBank's liquidity needs are driving the train here. But SoftBank and Microsoft aren't the only ones waiting at the station for this IPO.
Which brings us to the next layer of the cap table, the billionaire map. The early believers, the celebrities, and the employees. This is where the math goes from corporate finance to pure lottery ticket territory. Let's look at the venture capital and celebrity investments. Ashton Kutcher, for example.
Kutcher invested through Sound Ventures, which is a firm he co-founded with Guy Oseary. They deployed $30 million.
A $30 million check. And today, based on this $852 billion valuation, that stake is worth $1.3 billion. That is a 43x return on their money.
Which is incredible.
The report actually points out that this is a fascinating anomaly. Usually, celebrity tech investments are just vanity projects that yield a small PR bump. This is a rare case where a celebrity generated true dynastic generational wealth.
But then you look at the seasoned Silicon Valley veterans, and the multiples are just as wild. Take Vinod Khosla of Khosla Ventures. In 2019, he invested $50 million.
And the mechanism of how he invested is what's crazy. The report quotes him saying he did it with, quote, no conventional due diligence.
Right. In traditional venture capital, especially when you're writing a $50 million check, you spend months doing due diligence. You audit their code, you review their balance sheets, you stress test their business models.
Of course.
Khosla essentially skipped all that. He operated on pure conviction in the team and the underlying technology.
And that pure conviction turned his $50 million into $1.5 billion, a 30x return. Then you have Josh Kushner's firm, Thrive Capital. They've been leading rounds all the way up to this recent Series G. They've deployed a massive amount of capital, about $3.5 billion in total.
And that $3.5 billion position is now worth roughly $16.9 billion. A 4.8x return, which is phenomenal considering the sheer size of the capital they were deploying in the later stages, where the risk is theoretically much lower.
But the people who really break the math are the original 2015 angels, the founding donors from when it was just a charity, people like Reid Hoffman and Peter Thiel.
They collectively put in about $10 million in the very beginning. Now, over the years, as Microsoft and SoftBank pumped in tens of billions of dollars, those early angels were heavily diluted.
Let's explain dilution quickly. If I own 10% of a company and the company issues 1 million new shares to a new investor, my piece of the pie gets smaller, even if the overall pie gets bigger.
Exactly. The angels' ownership percentage shrank drastically. Today, they collectively own only 0.17% of the company.
But 0.17% of an $852 billion pie is $1.4 billion. They turned $10 million into $1.4 billion, a 140x return. The newsletter calls it the most heavily diluted path to $1 billion in history. We also have to mention Ilya Sutskever, one of the co-founders.
Yes, the source references court documents from November 2023, which revealed that Sutskever held $4 billion in vested equity when the company was valued at only $29 billion.
Wow, so if you scale that up to today's $852 billion valuation, Sutskever is sitting on tens of billions of dollars in vested equity, completely separate from whatever he is billing at his new venture.
Oh, yeah. But honestly, the group that I find most fascinating, the group that is going to fundamentally warp the local economy of San Francisco, is the employee pool.
The cap table allocates roughly 19% of the company to a pool of approximately 165 early employees.
19% of $852 billion is $165 billion, divided among 165 people.
It means the mathematical average early employee at this company is a billionaire. On paper.
Unbelievable.
The report explicitly calculates the average equity compensation at $1.5 million per year, which completely shatters the record for any tech startup in history.
Think about the internal HR dynamics of that office. You have mid-level software managers, people just, managing Jira tickets and debugging code, who know for a fact that they are literal paper billionaires. How do you manage a team where every single person in the room has enough paper wealth to buy their own private island? It creates a completely bizarre incentive structure. Because why continue to grind out 80-hour weeks? Well, because, as the report details, that wealth is currently trapped in a very specific legal cage. It goes back to the October 2025 conversion to a public benefit corporation.
Right, the PBC. How does that trap their money?
Under the old capped profit model, employees held profit participation units. When the company converted to a PBC, those units were converted into standard restricted stock units, or RSUs.
Okay, RSUs are standard tech compensation. They just vest over time.
Yes, but this specific conversion came with a brutal condition, a mandatory 2-year holding period.
Wow.
Even if the company IPOs tomorrow, those 165 paper billionaires cannot legally liquidate their converted RSUs for 2 full years. They're locked in.
So they have to sit and watch the public stock market fluctuate, completely unable to sell their life-changing equity.
Exactly. They're incredibly wealthy on paper, but entirely illiquid.
And the entity that built this cage, the entity that holds the ultimate power over the employees, the CEO, and all these multi-billion-dollar investors, is really the most confounding part of this entire deep dive.
It is the architectural anomaly at the center of the company, the nonprofit puzzle.
Let's lay out the corporate structure exactly as Jack Russo describes it in the newsletter, because it sounds like a riddle.
It really does.
At the very top of the org chart, you have the OpenAI Foundation. It is a nonprofit charity. Its cost basis for its shares is 0 because it was funded entirely by donations, not equity purchases.
And this nonprofit foundation holds 2.6 billion Class N shares.
Those are the magic governance shares we talked about earlier?
Yes. Economically, those 2.6 billion shares represent a 25.8% stake in the financial upside of the company, which is currently valued at around $220 billion. But functionally, because they are Class N shares, they represent 100% of the governance control over the underlying public benefit corporation.
The source uses this brilliant analogy to explain how backwards this is.
Oh, the hospital one.
Yeah. Imagine a local hospital foundation, a charity set up to raise money for, like, a children's wing. Now imagine that this little hospital charity fully owns and controls a $1 trillion global pharmaceutical company. The hospital charity's board of directors can legally fire every single executive at the pharmaceutical company whenever they want, even though Wall Street investors actually put up the billions of dollars to fund the pharmaceutical research.
It completely violates the standard social contract of venture capital. Normally, risk equals control. If SoftBank risks $64 billion, they expect to dictate the terms.
Right.
Here, Microsoft and SoftBank have deployed nearly $80 billion combined, and they legally have to defer to a nonprofit board that contributed $0 in equity capital.
How did it mutate into this? The report breaks the company's history into 3 eras to explain this evolution. Let's walk through them, starting with Era 1.
Era 1 scans from 2015 to 2019. This was the pure, idealistic 501c3 charity phase. The whole goal was to build open source AI for the benefit of humanity. Famous figures pledged $1 billion, but the report notes only $133 million was actually donated and cleared.
And you just can't build artificial general intelligence on a $133 million budget.
No.
Servers are expensive. So that triggers Era 2, 2019 to 2025. This is where the financial engineering really starts.
To attract venture capital, they created a capped profit LLC under the umbrella of the nonprofit.
Yeah.
The pitch to investors was, you can invest and you can make a profit, but your returns are capped.
Right.
Initially, the cap was set at 100 times your investment. Anything generated beyond that 100x cap would legally flow back up to the nonprofit foundation to be used for the good of humanity.
Now, the 100x cap is still an incredible return, but it is a cap. However, the newsletter flags a very quiet, very crucial modification to that cap.
Yes. The report notes that the cap was later quietly modified. It was altered to grow by 20% annually, compounding starting in 2025.
Wait, let's explore the mechanics of that. That is insane. It's like having a credit card where you promise to stop spending when you hit your limit, but every single year, the bank automatically increases your limit by 20%. If your cap is constantly expanding through compound interest, it ceases to be a meaningful cap. It's just a moving goalpost that allows infinite wealth extraction by the private investors before the charity ever sees a dime of that overflow.
And that quiet modification was essentially just a prelude to Era 3, October 2025.
The era of the Public Benefit Corporation, the Great Wealth Transfer.
This was the massive recapitalization where they shed the capped profit LLC entirely and became a formal for-profit PBC.
But if you are operating under the legal umbrella of a charity in California, you can't just wave a magic wand and declare yourself a for-profit company. The government definitely gets involved.
Absolutely. The California Attorney General stepped in to closely scrutinize the conversion. To allow the company to restructure into a PBC, the AG forced them to sign a Memorandum of Understanding, an MOU, in October 2025.
What were the actual terms of this MOU? Because it sounds like a leash.
It was a very tight leash consisting of 28 specific legally binding conditions. For instance, the company is permanently legally required to keep its headquarters in California.
Okay.
Its corporate mission must remain identical to the original nonprofit's charitable mission. Any decisions regarding AI safety protocols cannot legally factor in shareholder profits as a consideration.
That's a big one.
And crucially, the California AG must be given a mandatory 21 days notice before any change of corporate control can be executed.
Now, 28 conditions sounds strict, but according to the critics cited in the report, it was basically a smokescreen for the greatest heist in corporate history.
The critique centers entirely on the sheer volume of wealth that was redirected during this conversion.
Okay.
Let's go back to the mechanics of Era 2 for a second. Under the old capped profit structure, once the investors hit their return cap, which the report estimates would have been around $272 billion in total payouts if the company reached a $1 trillion valuation. Every single dollar of profit generated after that point belonged entirely to the nonprofit foundation.
Right. The overflow was completely dedicated to humanity, but under the new Era 3 PBC structure,
that cap is abolished. Under the new structure, private investors capture 74% of all value generated above the foundation's 26% stake. Forever.
Wow. So if you are a critic, you look at this and say, they took a structural promise that infinite future profits would go to a public charity, and they legally rewired it so that 74% of those infinite future profits go directly into the pockets of Microsoft, SoftBank, and 165 employee billionaires.
Exactly. Organizations like the Midas Project and Public Citizen have filed formal legal objections over this. They characterize this not as a simple corporate restructuring, but as a structural transfer of hundreds of billions of dollars from public benefit directly into private wealth.
The publication California Matters ran a piece arguing the AG settlement was, quote, full of holes. It is a staggering wealth transfer. And there is one individual who is looking at this wealth transfer and absolutely losing his mind. He occupies the most dramatic row on the entire leaked cap table.
Elon Musk.
Let's look at his row. Ownership stake, 0%.
Which is deeply ironic given his history with the organization. According to the source, Musk was one of the primary founding donors back in Era 1. He donated approximately $45 million of his own money to fund the original charity.
He funded the foundation, but he left the board in 2018. When they spun up the capped profit entity in 2019, he received no equity. When they converted to a PBC in 2025, he received no equity.
And his response to being boxed out was aggressive. The report notes that Musk recently submitted an unsolicited formal buyout bid for the entire company.
Oh, yeah.
He offered $97.4 billion.
A hostile takeover attempt of a private company. And OpenAI's response.
They rejected it outright.
And that rejection is what triggered total legal warfare, because Musk isn't just sending angry tweets anymore. He is suing OpenAI and Sam Altman for $134 billion.
It is a massive existential lawsuit. Musk is claiming that the money generated by this valuation constitutes wrongful gains.
Let's unpack the legal mechanics of this suit. What exactly is the premise of his argument? How does he claim he was wronged?
The case is Musk v. Altman, and it is scheduled to go before a jury on April 27, 2026.
That is just 3 weeks from the date of this newsletter.
Exactly. The core legal theory Musk's team is arguing is fraudulent inducement.
Fraudulent inducement. Explain how that works in this context.
So, In contract law, fraudulent inducement means one party was tricked or deceived into entering an agreement based on a false premise. Musk's argument is that he was fraudulently induced to donate his $45 million. He claims he was pitched a vision of a nonprofit, open-source organization dedicated solely to protecting humanity from the dangers of AI. He argues that he watched Sam Altman systematically engineer a conversion to a closed, for-profit structure, specifically for personal benefit and investor enrichment, fundamentally betraying the core promise that induced the initial donation.
He's saying, you lied to me about what we were building so you could take my money and build a trillion-dollar corporate monopoly. Now, without taking a side on whether his motives are pure or whether he's just, a billionaire experiencing intense FOMO because he missed out on the biggest tech run of the decade, his legal argument clearly has teeth.
It definitely does.
The judge didn't throw it out. It's going to a jury. And the CLG newsletter actually quotes the specific piece of evidence that Musk's lawyers are going to display on a giant screen in that courtroom.
Oh, it is a smoking gun.
Yeah.
It's a quote from a 2017 diary entry written by Greg Brockman, who is one of the key founding figures of OpenAI.
Read the quote, because it is just damning.
The entry reads, "I cannot believe that we committed to nonprofit. If 3 months later we're doing B Corp, then it was a lie."
Then it was a lie. Written by a core insider just months after the charity was formed, a full year before Musk even left the board. If you are a trial lawyer, that is the holy grail. The report characterizes this upcoming trial as the most consequential corporate governance showdown since the famous Revlon decision in 1986.
And this raises an important question, which brings us all the way back to the $60 billion question we discussed earlier.
Right. Sam Altman's pending 7% equity grant, the frozen payday.
Exactly. If you look at the mechanics of this lawsuit, you realize exactly why the OpenAI board is completely paralyzed. How can they legally or optically grant Altman $60 billion in stock right now?
They can't. If the foundation board, which Altman sits on, suddenly grants him a 7% stake worth $60 billion, 3 weeks before a jury hears a case about whether he orchestrated a fraudulent scheme for personal enrichment, it's legal suicide.
Yeah. Musk's lawyers would literally just point at the cap table and say, "Ladies and gentlemen of the jury, the defense rests. He just took $60 billion. We told you this was about personal enrichment."
The $134 billion fraud trial is a hard legal lock on Altman's compensation. And the stakes of the trial are binary. Either Musk wins, resulting in a historic $134 billion judgment that would instantly bankrupt or functionally cripple the company, or OpenAI secures complete vindication.
There's no middle ground, no quiet settlement expected here.
But if you think a $134 billion fraud trial is the only thing keeping OpenAI's general counsel awake at night, we really need to look at the rest of the docket, because the legal hurdles standing between their current private valuation and a successful public offering are staggering.
Let's run through the gauntlet of regulatory threats, starting at the federal level with the FTC, the Federal Trade Commission.
The FTC is running an ongoing antitrust investigation. What exactly are they looking for?
They are aggressively examining that massive partnership with Microsoft. The FTC has issued what are known as 6B orders to both Microsoft and OpenAI.
What does a 6B order do?
A 6B order allows the FTC to compel companies to conduct extensive internal studies and turn over massive amounts of internal data regarding their business practices. The FTC wants to know if that $250 billion Azure cloud commitment and the revenue sharing agreements constitute illegal, anti-competitive behavior designed to lock competitors out of the AI market.
The heat from that investigation must be intense because, as we noted earlier, Microsoft preemptively abandoned its board observer seat back in July 2024. They saw the FTC coming and tried to legally distance themselves. So that's the federal level. What about the state level?
The attorneys general are circling. We already discussed the California AG's 28 strict conditions and the mandatory 21-day notice for any change of control. But Delaware is also bearing down on them.
Really?
Yeah. Kathy Jennings, the Delaware Attorney General, has been remarkably blunt, stating publicly, "I'll file a lawsuit if I have to." Both states are aggressively monitoring every structural move the company makes.
Federal regulators, state regulators, angry billionaires. But the biggest regulatory hammer might actually be coming from across the Atlantic, the European Union.
The EU AI Act. The deadline for full compliance and enforcement is August 2, 2026.
That is just 4 months from the date of this newsletter. How does this act specifically target OpenAI?
Under the framework of the EU AI Act, OpenAI's models are easily classified as general-purpose AI with systemic risk.
Systemic risk? That sounds expensive.
Carries massive operational and financial burdens. It mandates strict ongoing model evaluations, rigorous transparency reporting about how the AI actually makes decisions, and the implementation of comprehensive systemic risk mitigation plans. You basically have to hire armies of compliance officers just to prove to European regulators that your software won't accidentally collapse a financial market or generate illegal bioweapons.
And if they fail to comply, like if a model hallucinates or violates the transparency rules?
The penalties are draconian, up to 35 million euros, or 7% of the company's total global revenue, whichever is higher.
7% of global revenue for a compliance failure. OpenAI is simultaneously the most valuable private company in the world and the single most heavily scrutinized legal test subject in modern history.
Exactly.
They are trying to build the most complex technology ever conceived while flying through a literal hurricane of government subpoenas and billionaire lawsuits.
Which brings us to the ultimate reality check, the moment where all this theoretical paper wealth has to be translated into actual cash.
Right, the secondary markets and the ticking IPO clock. Throughout this entire deep dive, we have anchored our discussion to that $852 billion post-money valuation. That was the official price negotiated by SoftBank, Thrive Capital, and the other Series G investors. But Jack Russo's newsletter makes a very stark point. The official valuation is not the reality on the ground.
Not at all. To understand the true market value of a private company, you have to look at the secondary markets. These are specialized trading platforms where early employees or early investors can try to sell their private shares to institutional buyers before an IPO even happens.
And the pricing on these secondary platforms is telling a much bleaker story than the official press releases.
The CLG report cites pricing data from two major secondary markets. Forge Global is currently pricing OpenAI shares at $715.37. Another platform, Hive, is pricing them even lower at $608.06.
Let's do the math on that Hive price. If you multiply the 23.4 billion total shares by that $608 price point, the implied total valuation of the company drops to roughly $700 billion.
That means the actual open market, the people using their own money to buy shares right now, is discounting the official $852 billion valuation by over $150 billion.
It's a massive haircut. And the trend is getting worse. The newsletter cites reporting from Bloomberg on April 1 stating that OpenAI shares have actually fallen out of favor with buyers.
Bloomberg reported a demand ratio of 0.6 to 1 on the secondary markets.
Break down the mechanics of a 0.6 to 1 demand ratio for us.
It means that for every 10 people trying to sell their shares, there are only 6 buyers willing to purchase them at current prices. It is a fundamental supply and demand imbalance. There is more sell pressure than buy pressure.
That's rough.
The report even notes that some institutional capital is actively rotating away from OpenAI, seeking better valuations in competitors like Anthropic.
We even saw warning signs of this internally. The report points out that back in October 2025, OpenAI ran an internal tender offer. They authorized $10.3 billion worth of shares to be sold by employees and early investors, but it was undersubscribed. Only $6.6 billion actually found buyers.
Yep.
The market simply wouldn't absorb the full amount at the price they were asking. So looking at all this data, I have to push back on the hype. I have to look at the fundamental business metrics here because the newsletter lays them out clearly and they are brutal.
The revenue numbers are certainly impressive on their face, though.
They are. The company is generating $25 billion in annualized revenue. They have 3 million paid enterprise customers. They have 500 million weekly active users. Those are incredible metrics for any software company. But the cost of running the infrastructure is destroying them.
The compute costs.
Yes. They lost $5 billion in 2024. They are projected to lose $14 billion this year in 2026. And cumulatively, the projections show them losing $44 billion through 2028.
It is a financial incinerator. They are subsidizing the cost of compute for every single user to drive adoption, but the underlying unit economics are deeply unprofitable.
So put yourself in the shoes of a mutual fund manager or a retail investor looking at a potential IPO. If the valuation is $852 billion and the revenue is $25 billion, that is a 34x revenue multiple.
Which is astronomical.
You are paying 34 times what the company makes in a year, and the company is losing $14 billion annually. Why would the public stock market support a 34x multiple for a company that burns cash at that rate, especially when they don't even have a moat to protect them from Google or Meta?
It is the trillion-dollar question that is keeping investment bankers awake at night. And this is exactly why we have to tie everything back to the single most important mechanism we discussed today, SoftBank's $40 billion bridge loan.
Ah, the ticking clock in Tokyo.
Exactly. The CLG report projects that OpenAI will file its S-1, the official, massive document required to initiate an initial public offering in the third quarter of 2026. They project the actual public listing will happen in Q4 of 2026 or Q1 of 2027.
And why that specific rushed window?
Because Masayoshi Son's unsecured bridge loan from JP Morgan and Goldman Sachs matures in March 2027.
So it all comes back to that.
Precisely. If OpenAI does not successfully execute an IPO before March 2027, Masayoshi Son cannot liquidate enough shares to pay back the banks. SoftBank would face a catastrophic default or a crippling, high-interest refinancing event on the largest debt position in their history. S&P Global would likely downgrade their credit rating immediately.
The realization here is profound. The OpenAI IPO is not just a celebratory milestone. It isn't just a liquidity event designed to let early employees buy real estate in Marin County. The IPO is a structural, existential necessity.
Yes.
It is a forced maneuver designed to prevent a cascading financial crisis for one of their lead investors. That March 2027 debt maturity is the gravitational pull dictating every single move the company makes.
It is the engine driving the entire timeline.
Okay, we need to take a step back and just absorb the sheer magnitude of what we have reconstructed today.
The complexity of this single cap table is staggering.
We started with the concept of an $852 billion pie sliced into 23.4 billion pieces. We found a CEO who built the most important company of the decade, yet legally owns exactly 0% of it, trapped in a holding pattern waiting on a $60 billion payday that he literally cannot touch. We uncovered a ticking $40 billion debt bomb strapped to the balance sheet of a Japanese conglomerate, forcing a premature IPO. We navigated a $134 billion fraudulent inducement trial brought by a founding billionaire. We examined the bizarre reality of 165 early employees who are paper billionaires, yet legally locked in a 2-year cage, praying the secondary markets don't collapse before they can sell.
And all of this is governed by a nonprofit foundation that contributed zero equity capital, but holds 100% of the control over the corporate empire.
It's wild.
And this is where we have to connect this massive abstract corporate puzzle directly back to you listening right now. It is really easy to view this as just high-stakes drama for billionaires. You might just use these AI tools to summarize a PDF or generate a piece of code.
Right.
But the financial machinery turning relentlessly behind that simple, clean chat interface is fundamentally rewriting the rules of global capitalism. It is testing the absolute limits of corporate law, it is drawing the attention of global regulators, and it is permanently altering the landscape of what we consider technology philanthropy. This isn't just a business story about a hot startup. It is a real-time structural shift in how unprecedented wealth and power are concentrated in the 21st century.
It truly is. And to leave you with one final thought to mull over, a thought that naturally builds on the brutal financial realities we unpacked from Jack Russo's analysis today.
What's that?
If Masayoshi Son's $40 billion loan comes due in March 2027 and the secondary markets are already balking at the massive $852 billion price tag, and the company is burning through $14 billion in cash this year alone, what compromises might a quote-unquote public benefit corporation be forced to make?
Oh, wow.
If the survival of their lead investor depends on a successful IPO, how much pressure will be applied to rush a product to market? What corners regarding AI safety protocols, or what aspects of their original charitable mission might they have to quietly sacrifice just to ensure this financial behemoth doesn't collapse under its own weight?
When a $40 billion loan comes due, noble intentions are usually the first thing on the chopping block. It is a terrifying, vital question.
Thank you so much for joining us on this deep dive. Keep questioning the mechanics behind the headlines. Always check the cap tables, and we'll see you next time.
Tune in next time on The Valley Current.